Hello everyone and welcome to edupediaworld.com. Today we are going to start Unit 2 of Chapter 1, Accounting and Introduction. We are done with the first unit of this chapter in which we have studied the meaning and scope of accounting, the various basic terms, and the various books of accounts as they are prepared in the process of accounting. Now in the second unit, the topics covered are accounting concepts, principles, and conventions. We are going to study the various accounting concepts on which the process of accounting is based. If we do not follow those concepts, then the process of accounting becomes really troublesome. So these accounting concepts are really important for preparing the financial statements and for doing accounting for any organization, because these concepts maintains uniformity between financial statements of various organizations. So let us start today's class, which will cover Unit 2 of Chapter 1, that is Accounting Concepts, Principles and Conventions. Let us first of all see the learning objectives for Unit 2 of this chapter. These are the learning objectives for this unit. Basic accounting concepts, principles, and conventions, their implications while recording transactions and events, how these concepts are applied while recording various transactions and events in the books of accounts, and number 3, identifying the 3 fundamental accounting assumptions: going concern, consistency, and accrual. These 3 are the 3 fundamental accounting assumptions on which the process of accounting is based. We have to just follow these 3 assumptions before preparing any books of accounts. And these 3 assumptions are implied assumptions, meaning that if it is not mentioned in the books of accounts that these 3 accounting assumptions have been followed, we have to assume ourselves that these 3 accounting assumptions have been followed by any organization, because these are the fundamental accounting assumptions. Until and unless we assume these 3 assumptions, the accounting books cannot be prepared. The books of accounting are based upon these 3 assumptions mainly, that is going concern, consistency, and accrual. We will be dealing with each of them separately and in detail as we continue with our class. First of all, let us start with the accounting concepts, principles, and conventions. Before starting with the definition of the accounting concepts, let us first understand why those accounting concepts are important for the purpose of accounting. Accounting is the language of the business. The business is reported, the business is presented in the form of its accounts. We can make out where the business is going through its books of accounts and through its financial statements. So we can say that accounting is the language of the business. It is the language in which the business is reported. Now, financial statements prepared by the accountant communicate financial information to various stakeholders for decision-making purpose. We have studied in the Unit 1 of this chapter who are the different users of the accounting information. There were the owners, the investors, the creditors, the lenders, the customers, the government, etc. So many stakeholders were there who were the users of the accounting information. Now, the financial statements which are prepared are used by these stakeholders for rational decision-making purposes. Therefore, it is very important that financial statements prepared by different organizations should be prepared on uniform basis, because these stakeholders requires to compare the various financial statements of different organizations before taking any decision. For example, if I am an investor and I am planning to invest my money into some organization or some business, So before I invest my valuable, my hard earned money, I will make comparison of various organizations. And how I can compare the organization? Through their financial statements. And until and unless the financial statements of all the organization are prepared on the uniform basis, I cannot compare those statements. If one organization is preparing their statements by following completely different set of rules, and one organization is preparing their financial statements by following their own set of rules and principles, then it becomes very difficult for an investor like me to compare those two financial statements for the purpose of investing in them. Until and unless they are prepared on the uniform basis, they cannot be compared. So, it is very, very important for any organization to prepare the financial statements on a uniform basis so that various stakeholders can make use of those financial statements for rational decision making. Also, there should be consistency over a period of time in the preparation of these financial statements. Consistency. By consistency, we mean that it should not happen that in one year I am following different set of rules and in another year I am changing all the rules followed in the previous year and I am preparing my financial statements by following a totally different set of rules and principles. So this should not be there. There should be consistency in the preparation of the financial statements over a period of time. I cannot change my set of rules and principles year after year just because my financial statements are not showing favorable results. I'm changing my set of rules and principles to make my financial statements look favorable. So this should not be the case. We should follow a given set of rules consistently over the period of time. And those given set of rules and principles are the basic accounting concepts, which we are going to learn in detail in this class. Now, if every accountant starts following his own norms and notions for accounting of different items, then there will be an utter confusion. Obviously, if all the accountants starts following their own terms and conditions for preparing the books of accounts of various organizations, then there can be no consistency and no comparison and no uniformity, and there will be an utter confusion. Various stakeholders who uses the financial information for making decisions cannot take any rational decision because they will not be provided with the true and fair picture of the organization. So it is very important for all the organizations to follow a uniform set of rules and principles for preparing their financial information so as to render them useful for the various stakeholders who uses those financial information for various decision making purposes. So this is the reason why various accounting concepts have been developed over the years, which are followed by the accountants worldwide to prepare the financial statements and prepare the books of accounts so that they are presented in a uniform manner, in a consistent manner, and which render them comparable so that the stakeholders can compare the financial statements of different organizations and take the right decision. So this is the reason, this is the basic reason for the development and evolution of different accounting concepts. So to avoid confusion and to achieve uniformity, various accounting principles, concepts and conventions are developed. Now, for our study and for our purpose of examination, the terms accounting concepts, accounting principles, and accounting conventions have been used interchangeably to mean those basic points of agreement on which financial accounting theory and practice are founded. So, in this unit, in this chapter, we'll use these terms of accounting concepts, accounting principles, and accounting conventions interchangeably, though they are different terms, but They are more or less similar. We can say that the concepts, conventions, and principles are more or less the same thing. So, in this unit, they have been used interchangeably to mean those basic points of agreement on which the financial accounting theory and practice are founded. These are the basic points, we can say. The concepts, conventions, and principles are the basic points on which the financial accounting is based, and following those, the financial statements are prepared. Now, let us see the meaning of accounting concepts and the various accounting concepts which are followed by accountants to prepare the financial information to render them consistent and uniform. Accounting concepts. What do we mean by accounting concepts? Accounting concepts are the assumptions on the basis of which financial statements of a business entity are prepared. So, what are the accounting concepts? They are basically the accounting assumptions on the basis of which the financial statement of a business entity are prepared. We have to assume that these accounting concepts are there in order to prepare the financial statements. If we do not follow these accounting concepts, then the financial statements will be inconsistent and will not be uniform. So we have to follow these assumptions known as accounting concepts in order to prepare the financial statements in a consistent and uniform manner. Concepts are those basic assumptions and conditions which form the basis upon which the accountancy has been laid. So these are the basis of accountancy, we can say. So this is very important because it is the foundation upon which the whole process of accountancy has been laid upon. These are the basic assumptions and conditions. So just remember that accounting concepts are the basic assumptions and conditions based upon which the financial statement of any business entity is prepared, so that those financial statements appear to be uniform and consistent and are useful for the various stakeholders and help those stakeholders in rational decision making. Now let us study one by one these accounting concepts. The various accounting concepts on which accounting is based are as follows. The first concept in line is the entity concept. What do we mean by an entity concept? The business enterprise is a separate identity apart from its owner. So, in this concept, we are trying to imbibe that the business which I am running is a separate thing and my identity is a separate thing. So my business is having a separate identity and I am having a separate identity. Though I am the owner of the business, I have provided all the funds to the business and I am only the sole owner of all the profits which the business is earning. Still, the entity concepts treats the business as a separate entity and the owner as the separate entity. So the accountants should treat a business as distinct from its owner. The purpose is to eliminate personal transactions from business transactions. The main purpose of this concept is to differentiate between personal transactions and business transactions, because it may happen that I am also doing personal transactions from my business earnings. So we have to eliminate those personal transactions from the business transaction to present the real picture of the business, that is what the business is earning and what is the position of the business after deducting the personal transactions, after eliminating the personal transactions. So this is the main purpose of the entity concept. Now let us take one example to understand this more clearly. You have understood the basic, that is the separate identity of the business from its owner. The underlying concept of this entity concept is the separate identity of the business from its owner. The separate identity of the business from its owner. The owner is a different identity and the business is the different identity. Now let us take one example to understand this entity concept in more detail. For example, let us take that Mr. X started business investing rupees 7 lakh, with which he purchased machinery for rupees 5 lakhs and maintained the balance in hand. So, here the situation is that Mr. X have started Mr. X has started a new business in which he has invested rupees 7 lakh rupees. Now this 7 lakh is the capital which the business owes to Mr. X. Mr. X is the different identity and the business is the different identity. So Mr. X is giving rupees 7 lakhs to the business in the form of capital investment. Now the business with this 7 lakh rupees is purchasing a machinery for rupees 5 lakh and maintaining the balance cash in hand. So the financial position of the business, which is shown by the balance sheet, will be as follows. The financial position of any business is shown through this format of balance sheet. We can know the financial position of any business by preparing this financial statement known as balance sheet. So this is how the financial position of the business of Mr. X will be depicted. On the liability side, capital of rupees 7 lakh, which is given by Mr. X to the business in the form of investment in the business. And from these 7 lakhs, the business purchased machinery for rupees 5 lakh and the remaining was cash in hand. So both the sides are balancing. Capital 7 lakh and machinery plus cash 7 lakh. Now this means that the enterprise owes to Mr. X rupees 7 lakh. The business is having the liability to pay back rupees 7 lakh to Mr. X, which he has invested in the business, because Mr. X is the different entity and the business is the different entity. Though Mr. X is the owner of the business, but due to this entity concept, we consider the business as a different entity and Mr. X as the different entity. So the 7 lakh which Mr. X has invested in his own business is the liability of the business to pay back to Mr. X. Now, if Mr. X spends rupees 5,000 to meet his family expenses from the business fund, then it should not be taken as business expenses and would be charged to his capital account. That is, his investment would be reduced by rupees 5,000. We have studied in the previous slide that the main purpose to differentiate between the owner and the business is to remove the personal transactions from the business transactions. So this is the case. Now Mr. X is spending rupees 5,000 from these funds which he has invested in his own business to meet his personal expenses. So these are not the business expenses. So the business will not bear them. Rather Mr. X will bear them. So how this transaction will be accounted? The 5,000 which he has used for personal transactions will be deducted from his capital account and his capital will be reduced by rupees 5,000. So now, following the entity concept, the revised financial position would be as follows. The capital of Mr. X will be reduced by rupees 5,000 as drawings, or you can say personal expenses. So the remaining capital will be 6,95,000. And on the asset side also, the cash balance will be deducted by rupees 5,000. So the remaining cash balance will be 1,95,000. So again, the balance sheet will be balanced. The liability side will also be 6,95,000 and the asset side will also be 6,95,000. So this is how the entity concept works. The identity of the owner is different from the identity of the business, and the main purpose of differentiating both the identities is to separate the personal transactions from the business transactions. Thank you, students. Hope you have understood the importance of the accounting concept in preparation of the financial statements and the first accounting concept that we have started, that is the entity concept. In the next class, we will be studying the remaining accounting concepts which form part of Unit 2, that is Accounting Concepts, Principles, and Conventions. Thank you.